Welcome to episode 38 of the Cashflow Connections podcast. Our topic for today is, will we set the record for longest economic recovery ever? Our guest today is a wicked smart economic researcher who focuses on recessions, their leading indicators, and their implications, mostly in an effort to advise real estate investors, builders, and real estate focused hedge funds. I honestly can't think of a better guest for this podcast. We don't really waste any time jumping into some of the details in terms of what she is seeing in terms of recent data. We cover a ton of ground in the conversation and discuss virtually every major driving factor of the economy in less than an hour. One of the first things we talk about is why tracking the length of the time of an expansion doesn't really paint the whole story, but it's certainly something to keep an eye on. This is a metric you hear frequently cited, but there's obviously a lot more details than just the time of the expansion. We also talk about what the quit ratio tells us about where we are in the cycle, and why the spread between the 10-year and the 3-month bond yields are a major leading indicator for predicting recession, and what this metric is currently suggesting about where we are. We also have a discussion about the purchasing habits of millennials, which will play a key role in the state of the housing market over the next few decades. It also happens to be one of our guests' key interests. Now, as many of you know, there are many different ways to assess the value of real estate. You can look at cost per door, you can look at the cash flow, you can look at the potential for future appreciation, but I've always held that NOI is probably the most accurate because NOI is how cash flow is paid, right? And so it's really about the demand for the product and the profitability of the asset as a whole. Now, the reason I say this is that if you want to look at why I have been so excited about the mobile home park and self-storage asset classes over the last several years, feel free to check the show notes page out. In this episode, you're going to find the same store NOI growth for all commercial real estate assets. I'm talking about apartments, industrial, office, shopping centers, etc. Guess which two are leading the pack? That's right, mobile home parks and self-storage, both with almost a 70% increase in same store NOI growth since the year 2000. This is a very simple chart, but it paints a very accurate picture of the ever-increasing demand for these two asset classes. And based on several economic data points, which I've touched on many times previously, I don't see this changing anytime soon. So if you're interested in getting more exposure to the mobile home park and self-storage asset classes, head over to cashflowconnections.com and sign up as an accredited investor. These two asset classes make up the majority of my commercial real estate holdings, and I'm really happy with that. I don't see that changing anytime soon either. So like I said, if you're interested in getting more exposure to these, head over to cashflowconnections.com, create an account, and we'll get you cash flowing. All right, hope you enjoy the episode. How's it going, everyone? Our guest for today is Ali Wolf, who is the Director of Economic Research for Meyers Research. As head of the economics department, Ali manages and analyzes the content for Zonda, provides data analytics, runs special research projects, and does presentations across the country on topics ranging from the housing market to the economy as a whole. Prior to joining Meyers' team, Ali headed macro, regional, and metro-level monthly economic reports at John Burns Real Estate Consulting. Ali was also a researcher for both the Canadian and UK parliaments. She holds a bachelor's degree from the Ohio State University in economics and a master's degree from the London School of Economics in real estate economics and finance. So anytime we got the word economics, 10 times in the bio, really excited to get on the call. So Ali, thanks again for coming on.
Yeah, of course. Thank you for inviting me.
Awesome. So, before we get into some of the details, we're really trying to get a, understanding of where we currently are in this whole economic cycle. I'd like to get just kind of your perspective on Meyers Research and kind of the products you guys offer for your clients.
Sure. So we are that's based in California, but we have 80 experts across the country, ranging from Florida and Texas to Rhode Island. We do feasibility studies, you do best use studies, working with builders, developers, hedge funds, banks, private equity, pretty much anyone you can imagine. And we also have an iPad app called Zonda. So any piece of data you want as it relates to housing or economics, we have that starting on a national level, going to state, and broken all the way down to zip code level. So for a lot of our builder clients, we have different programs that are within Zonda that help streamline their everyday process. So it's all about efficiency. We know that everyone's busy, so how can we help you do your job better and quicker?
Okay, perfect. So you're ranging all the way from hedge funds to developers. How much of your clients are typically real estate based, or is that the vast majority of what your focus is on in that market?
Vast majority will be real estate based.
Okay, perfect. So, a lot of my investment thesis is really been built around recessions and recessionary economic data and economic trends. I guess for this purpose of the conversation, before we kind of jump into that whole discussion, how would you define a recession in terms of how it pertains to this conversation?
Well, first off, I have to say, I am so excited to talk to someone else who's excited to talk about recessions. This is one of my favorite topics. I've done so much research into this. And defining recession, it's a bit different of how a person feels on the ground versus what the data shows. But the data is obviously the easier measure to look at. So it's technically defined as 2 consecutive quarters of negative GDP growth. And we use the recession dates that come from the National Bureau of Economic Research.
Okay, that's actually the same data points that I'm looking at, and so just wanted to clarify that for the investors. So, one of the interesting things about this recovery, if you're looking at that website you just mentioned, you can see that we are currently in the middle of one of the longest recoveries since the bottom, the trough, unrecorded history. Since like I think it's 1857 is I think when the data starts. So, what are some of the key differences with this recovery, and how do you view this recovery as opposed to some of those previous recoveries that have taken place, historically
So,
speaking?
and in fact, we are 2 months shy of the second longest expansion in history. So people hear that, and I try to shy people away from it. And I think we'll probably talk about this a little later. But a long expansion is not the concern, it's all of the other things that are going on. But to go back to your original question, if you think about the Great Recession and that kind of leading up to that, that cycle was known for overbuilding, for faulty mortgages, owning multiple investment homes, shady tactics. There were a lot of different interesting components that contributed to the last housing boom. For this cycle, the name of the game is affordability. We saw that wages kept dropping. I think it was 2 years, wages kept going down while home prices started to go up. And then we've seen kind of that growth of home price appreciation, of rent growth, and how that has completely diverged from what we're seeing in wage growth. So you're not having builders overbuild. You're seeing months of supply that's at some of the lowest levels we've ever seen in history. And you have a lot of demographics in the favor for demand saying, we want to come out and buy homes, but there's nothing there driving up prices, making affordability a huge issue.
Interesting. Okay, so you touched on a lot of things there. So affordability. So in terms of development, during the end of the cycle, this is usually how the cycle ends up correcting. It's a combination of a bunch of supply happening, as well as other capacity, as well as kind of restrictions on debt. So in this recovery, is it that you haven't really seen the same amount of development as you may have expected given the demand situation? Is that part of is part of that because of the mental game of what happened as the last correction was so serious, focused on debt, and obviously real estate played a major role in it. So yeah, just to kind of restate the question, is the mental aspect prohibiting that development, or what do you see as maybe being the major prohibitor of that development and increase in supply?
Oh, it's so fun. So I love behavioral economics. That's one of my kind of pet projects that I work on the side. And so part of it is, yes, we talk about PTSD, and maybe that's too extreme of a phrase to use for this, but you have a lot of people that are so scarred from the last cycle that the same kind of risks they would have taken on in the past, they're saying, well, hey, I'm not sure I want to take on that same level. But what I've heard a lot of people say is, oh, well, I'm just going to wait for land prices to correct, because land prices have taken off because they remember back 2005, 6, 7, how much they could get for their land. The problem is, once you set that anchor, why do these people want to lower their price of land? They say, I've seen that I can get X, and I'm going to wait and hold out till I get X because you're not creating any more land. So it's a really interesting dynamic of both land availability, lack of development, plus, I don't want to go too technical here, but if you guys know John Nash in game theory, when you look at the resale market, there are a lot of people that would love to move up or change homes, but they don't see other homes on the market. When they don't see other homes on the market, they don't want to sell their house and have to go into an apartment. So they don't want to put their house on the market. So it's kind of this perpetual cycle where there's no homes, I'm not going to sell. But if everyone just had agreed to put their homes on the market, then I think we would back to normal fundamentals. So it's a big demand issue right now.
Interesting. That's definitely interesting. You mentioned the length of the recession. I think this is kind of a stage or kind of a quote that people say frequently, which is that no recession ever died of old age.
Hmm.
That is never the case. There is almost always mania prior to there being a correction. If there isn't mania, then the correction cannot really be significant enough to cause anyone to be talking about it, let alone for years in the future. So, why does the length of the recession, the expansion, I should say, why is that not painting the whole picture? And do you use the length at all in your analysis? Is that something you consider at all? What are your thoughts on that?
So this is probably a morbid way of explaining it, but the way I think of it is as you get older, you're more likely to have some ailments. And that kind of is the same way I look at as a human. So the kind of same way I look at expansions is it's not the fact that you're 70 that's going to kill you. It's maybe something that's going to come in that it's whatever it is, cancer, whatever, for humans. So same thing. I went through all the recessions over the past 50 years, looked at any either leading indicator or any commonalities. And so I found 13 that I include in my analysis that I monitor regularly. And of those 13, there's 3 that I'm seeing right now that, you know, relate to past recessions. So for example, higher interest rates. We'll probably talk about this later. They're not high by historical averages, but they're increasing. Or debt. Debt, if you adjust for population, is still close to the highest level ever. And then even rising oil prices. Again, historically not to the point of $100 or $150 a barrel, but we are seeing that increase. So it's the fact that age doesn't matter, catalysts do. What are you seeing that could derail an expansion? And those are what we look at.
Right, for sure. And I mean, you touched on a lot of the major points there. So I guess the question then becomes, where do we go from here, given those major indicators are all topping out or really close to topping out? Have interest rates really, really low. From a real estate perspective, cap rates are quite low. Occupancy rates are quite high. It's hard to make the argument that we're not in the late stages of this. I mean, what are your thoughts on, going forward the next 2-3 years?
So it's so funny you say that. I was hired for an assignment that said, make a case that this expansion will last for the next 5 years. So at first I thought that was quite daunting because I'm kind of the same mindset as you. Oh, well, there's signs that it could be late cycle. I could do that assignment so easily. I could not believe how many indicators I could find that would say, this is going to last 5 years. Don't worry. But just last week, I was hired to also make a case that the expansion will only last another 2 years. I could do that assignment so easily. And I was like, how are we at this point that I can as equally say this will last 5 years as I can say this will last 12 months? So it's such an interesting time right now. This tax reform bill, I don't know if we were planning on talking about that, but I would say that adds some fuel to the fire. You talk about lower tax rates, lower tax brackets, doubling the standard deduction, lower corporate rates, a lower pass-through income tax, all of those different things, giving more money to consumers, giving more money to corporations. Hopefully they will go out and continue to spend and invest and increase productivity and extend the length of the expansion.
Yeah, that's fascinating. I definitely the tax laws and the changing of the tax laws is something that I only tertiarily pay attention to. It's just kind of something that I have to do from a business ownership perspective. But I think it's a great point. To your point you made earlier about, I think the longest expansion ever has been about 120 months. So if Trump actually makes it in through the first term, it will set the record for the longest expansion ever, which is pretty much the sole goal of every politician that I've ever encountered. So you can definitely see how you'd want to just continue to inflate and inflate. But, at the end of the day, the old saying, you can't push, pushing on a string, et cetera, in every single way. So what are some of the, you mentioned the jobs that you've just recently on. What are some of the metrics that you look at to identify that or to make those cases?
Now, let me go back to your comment before I answer that. And if you want to draw parallels to other expansions, so the Clinton expansion is the one that was the longest on record. And about 6 years into that expansion, the administration decided to cut corporate tax rates pretty heavily. And in doing so, you're not going to say that's the only reason that expansion continued its strength for as long as it did. But part of me sees the parallels and, okay, They had a really strong expansion. They cut taxes. That propelled it. Are we going to see the same kind of parallels? Noting, though, during Clinton, they had a budget surplus, and we have a pretty ugly deficit right now.
Right.
So again, it's not that easy to say apples to apples, but I just wonder if you'll see the same kind of growth based on the tax reform.
Certainly.
Now, back to your other question. What I found in one of my assignments was every recession over the past 50 years was preceded by a drop in housing permits. And I have never heard anyone cite that data before. And it's anywhere between a year and 4 years before the recession, there started to be this trending down in housing permits. So that's one thing I at least want to keep my eye on, because we are seeing starts and permits are still increasing in today's environment. So that's one of the measures I look at. Another is manufacturing. So if you look at the ISM manufacturing index, not every time that it goes below 50 is there a recession, but every recession is corresponded with when that index goes below 50. And we're seeing that number still trending up in the 60s. So another kind of, I know that every recession is different. And if I could predict recessions, I probably wouldn't be talking to you today. No offense. I'd probably be, lounging on a beach or something. But those are a couple of the indicators I look at. But I also like to look at the labor market. Not necessarily non-farm payrolls, even though I think the first Friday of every month is the most exciting day of the month. It is not a leading indicator. So it's a little bit of a shame when you look at that. And jobs on the whole struggle a bit to be a leading indicator because people try to be more bullish than reality. I think sometimes people try to say, oh, we can escape this. Let's keep hiring. We're still seeing growth, but then they need to start pulling back. But in particular, I like to look at quits and I like to look at initial jobless claims.
Okay. And then why is it that quits kind of pique your interest?
If you are working at a job and someone comes and approaches you, if you think, okay, I'm going to join this company and the first 6 months of that job, I'm probably going to be dispensable because I'm still kind of have this learning curve and I'm probably, I'm not tenured like everyone else. I think people think about that before they switch their job. And if you're deciding to switch, quits are close to the highest level ever. You have people that are saying, I think this economy is going to keep going. I feel pretty good about where the labor market is today. And let's go ahead and make the leap. Maybe I'll get a 15% bump in my income. Plus, I feel a little bit better about job security because the economy is chugging along so well.
Okay. And then is that something that's kind of related to consumer confidence in the sense that when it gets close to its all-time high, it's typically right before the end of a cycle? I mean, is that something that's like counter-cyclical, or what are your thoughts on that?
So the data doesn't go far enough back for you to see many recessions. The recession 2 times ago, yes, you did see that. Kind of once it hit its top, it started to go down. During the last cycle, to me, when I look at the data, I see more of it's gone up and it stayed up for a fairly long time, then started to show a little bit of a decrease, and then it kind of signaled the recession. So okay. Yes, you can see that, but it's just, I don't think we have enough history to say it always does that, like you could maybe with consumer confidence.
Okay. And is there any industry specifically that you follow that can really give you a good idea? Like, is the service industry or the manufacturing industry that you mentioned, are there any specific industries that you look directly to as opposed to others that maybe you don't think are that important when analyzing this data?
Me personally, no. I don't look at data that way. I look at ADP, so the payroll processor. You can get data from them, and they cover 1/6 of the entire country of all the different payrolls. And they can tell you migration patterns, they can tell you incomes, they can tell you wage growth, they can tell you where people are moving in and how much money they're bringing in with them. So I like to look at that and layering in changing sectors / adding diversity. So if you look at Houston, in the past, I would say Houston, people would say oil. And now you look at Houston and you're like, oh, there's oil, there's accounting, there's advisory. So I like to find different markets, and I like to see that diversity is changing. Same with Orlando. Used to be leisure. Now they have a whole bunch of different opportunities in those markets. So I try to look at more, is one sector dominating and that market may have more risk, versus does it have enough room that if there's a slowdown in tech, they can still make up for it because they have all these good healthcare jobs.
Got it. Okay. Let's talk a little bit about the housing market. Just give us a brief overall view of where your perspective is on the current state of the housing market, and are prices increasing or softening? What are your thoughts on both rental rates as prices and I guess the housing market as a whole?
So I'll kind of segue into this, finishing with the jobs and going to housing, is if you look over the past 2 years nationally, wages are up 6%, sorry, 5%, wages up 5%, new home prices up 8%, existing home prices up 13%, rent up 9%. So going back to, people have jobs, and do they have the wage growth that can, or back to affordability again, that can allow them to purchase homes? We're still seeing this big divergence between 13% growth in home prices, 5% in wages over 2 years. So when we talk to builders and a lot of our clients, I've been on a roadshow the past 2 weeks. I've been to 5 different markets talking to builders. And I said, hey, how have year-to-date sales been for you? Across the board, everyone says way better than I expected, especially considering we hadn't even hit the spring selling season until Super Bowl. People still said we are seeing really good strength. Problem is, we talked about this a little bit earlier, mortgage rates. I think there's a lot of debate in the housing market of, will rising rates impact sales? But no matter where I go, I kind of have this calculation, okay, if rates go up 50 basis points, how does that impact affordability? This is a small market, but for example, I was in San Antonio yesterday. If rates go up 50 basis points, that changes the monthly payment by $60 a month. Now, some of your listeners may say, well, it's $60. Like, I can go out to dinner for that. That doesn't mean anything. But in a lot of markets, some people look at this from kind of, they earn good money and maybe they're in kind of this special part of the economy. There are a lot of just working class people that fuel the housing market, that a $60 payment change is definitely going to change the equation and make it harder for them to purchase a home. So I think right now we're seeing a lot of strength, but we're also seeing a little bit of caution and worry about what the next year looks like.
Certainly, especially given, the where interest rates are, historically speaking. When you look at affordability, what do you measure that in a percentage, as in the percentage of people that can afford a property with a certain down payment, or what is that metric when you look at it?
Yep. So we have that metric across every top MSA in the country. I don't have the stats in front of me, but I know, for example, and this probably won't surprise people, I live in Southern California in Orange County, and it's 11% of households can afford the median priced new home, assuming a 20% down payment. Now, we all know not everyone can do 20% down, so that number is going to look a little bit worse when you start to say, actually, no, it's 15%. They're going to have PMI. That'll change the equation as well.
Wow, that's the first time that I've heard that reading recently. It hasn't been that low the last time I checked. I know Bruce Norris is someone that tracks affordability very closely. That's fascinating. The number that he kind of looks at is 17% affordability when California has historically kind of experienced significant corrections. I don't think we're quite that low yet, but there's some arguments to be made that it may not get quite that low just because of a variety of factors. People are kind of moving in and out of California. The net migration out of California is something that hasn't really happened to the same extent as it has been previously.
California
Go ahead.
People moving into California are moving out. So still a balanced market despite what we are seeing with affordability. My concerns, if we were talking about California, is it's no surprise that Orange County, LA, San Francisco, San Jose, those markets are expensive. You know that. They're desirable places to live. You have a lot of young people that are getting high-paying jobs that are heading there. That makes sense. What makes me a little bit nervous is probably the wrong word, but we're seeing affordability challenges in Sacramento and the Inland Empire that we haven't seen in 10 years. So when I went to Sacramento, affordability is the number one thing that they're going to talk about. And so luckily in their market, they're able to do some density solutions, some smaller product or some attached product to help solve for that. But at what point is that what consumers want, or consumers just willing to do it because they want to purchase a home and think owning's better than renting?
Right. And that is one of the major things that is kind of up for question right now. One of the questions that I think a lot of people, this is really, really important in the last expansion, was that people were willing to do a lot in order to own. People were willing to drive far. People were willing to buy smaller or larger houses, whatever. They were willing to just do anything to own because they didn't want to miss out on the opportunity. Are you seeing, from a mental aspect, are you seeing that take place? Do you anticipate that taking place later in the cycle?
One of the things that when I go around the country, I always want to talk to mortgage brokers and say, what are you seeing? Are there any red flags that we should be paying attention to? And the only one that I'm hearing, at least in terms of people really stretching their income, is now they're allowing that 49% DTI, debt to income ratio, and they're allowing that pre-tax. So, I mean, when you think about that, what your paycheck should be and what your paycheck is, that makes me a little nervous that they said they'll do anything. And that's what I say to builders is I said, will they do anything to be able to purchase? And they say, yeah, right now we're still seeing it. But that doesn't mean, if you know Victorville, that doesn't mean there's so many communities building up in these far, far outlying areas like we saw in the past.
Right.
But we are seeing some, young people in particular that say, I know it financially makes sense for me to be a homeowner. And if that means I have to move to Ontario from Irvine, again, this is all Southern California focused. We are seeing some that are willing to do that. And the Inland Empire we're calling hot right now. So there's a lot of sales going on and a lot of development.
So I know that one of your specialties or one of your interests is in, millennials and the buying power that they possess. Are you seeing, the same mentality? I guess this is something that comes up a lot in these conversations, particularly as it relates to self-storage, which is something I'm really interested in. People say, look, millennials aren't really buying right now. Is that actually the case? I mean, what are your thoughts on their interest in actually owning versus renting?
Millennials 100%, sorry, I guess I should say 95% want to own. I survey millennials every year and I ask them, when are you planning on purchasing your home? And I have 5% of them that say never. There has not been this huge mind shift where they're saying, nope, I don't want to own. It's, I definitely do. But I also have some hurdles that are even higher than previous generations when it comes to actually being able to purchase, though.
Yeah, I agree completely. I think part of that is because of the fact that it's very challenging to buy a home in Los Angeles and New York and San Francisco. And a lot of the companies that make the media as a whole, they're in those markets. So go to someone in Memphis, Tennessee and ask them if they're planning on buying a home. They are, and they're planning on buying a home for $150,000. So that's something to consider. That most people do not live in Los Angeles, where it's very challenging to buy a home. Most people do not live in Manhattan. Most people want to own. And I think that's something that's kind of overlooked because of the narrative which is being pushed from those major areas which control most of those media outlets.
100% agree. I'm from Cleveland originally, and I talked to some of my millennial friends that still live there, and they'll be saying, I just went into a bidding war, 20,000 over asking price. And this is Cleveland, where your base price is 150 or 200. So it's really interesting because the bidding wars are happening across the country because you do have these young people that want to come out. There's 83 million of them, and they're ready to buy homes. They're finally hitting that point that they're having kids, that they're getting married, and they're going to do that. Going back to affordability, though, I just want to touch on a few of my kind of favorite markets right now that we're seeing. And one is Denver. Do you study Denver at all?
Yeah, absolutely. And I went there recently without looking at any data. It's just unbelievable with what's going on there. I mean, you can feel it is happening, but I'm definitely interested to hear your perspective on affordability because that's something I've heard kind of differing opinions on.
Oh my gosh. Okay, this is where I need to step back. If you are from California and you move to Denver, Denver is a steal. It is awesome. You get a single family detached, you're close to downtown, you're close to lifestyle, skiing, hiking, all of that good stuff. If you were born and raised in Denver, that market is unheard of. It is crazy. I again, don't have my stats in front of me, but I think it's something like since the previous peak, Denver home prices are up 37%. Now, they didn't have a huge peak and a huge trough, so you're kind of not basing it off of a heightened number, but now they are finally kind of starting to see that huge growth. I bucket all of the top markets in the country into thirds. And I say, okay, a third are least affordable, a third are moderately affordable, and a third are most affordable. And Denver now has switched, and now Denver's playing in the same game as Seattle, as San Francisco, as LA, as Miami, as New York. So really interesting change.
Yes, and I think the key there is that that has historically not been the case. So,
Mm-hmm.
in order to buy into the Denver thesis, you have to say the thing that the economists don't really like to hear, which is this time it's going to be different. Now,
Mm-hmm.
Denver is Los Angeles. Now, Denver is the new Manhattan. I guess the counter, and by the way, I completely agree with you. I am not buying there and not be even looking there, which is why I'm not, focused on that data. But
Mm-hmm.
I think that what is certainly also happening, and I don't have the exact number either, but there are, I think it was, oh gosh, I don't want to say wrong, but there's tens of thousands of people moving there on a monthly
Mm-hmm.
basis. Like it's crazy. I think they're anticipating 170,000 people, something like that. Do you have any like thoughts on that? Being that the job market is basically exploding, the tech companies there are just exploding. Do you think that that will balance out that lack of affordability, or do you still think you wouldn't touch it wouldn't touch it at all?
So I was in Denver last week, and I like to survey builders and say, hey, what's the biggest problem that you're facing in your market? And I usually kind of give them the top three, which is cost and availability of land, cost and availability of labor, and then building material prices. For Denver, and this is not across every country, for Denver, 100% of the hands went up for cost and availability of labor. So for them, if you have all of these people moving into Denver, but they're not moving in to help build homes, they're not skilled, they're not trade workers, they're just doing other things, that's going to make the problem even worse. You're just adding more demand, and they're not getting more trade roofers. They're not getting more trained, drywall installers. So they can't keep up with demand. Plus, Denver has all of those construction defect litigation laws. So yes, they had a victory. I think it was last year they had a victory, and they're starting to see more attached product. But in some of those expensive markets that you were talking about, Los Angeles and Manhattan, they do high density attached product because they know we have people coming. Again, if you want to own a home, sorry, you can't get a single family detached. You have to do attached. And that's not taking off in Denver as you would think because of the construction defect and because they don't have many workers that can keep up with demand.
Interesting. Let's go back to the millennials real quick. I wanted to touch on something which is really, really in the news really frequently, about $1.3 trillion in student debt. And I know that that just recently surpassed the credit card debt. How does student debt play a factor in this conversation regarding millennials purchasing properties?
So I have this stat. I got to pull up the stat because I don't want to misframe this. Okay, here we go. What we have is in 2007, 16% of all households had student loan debt. Today, that's gone up to 22% of all households have student loan debt. So you're talking about 1.3 trillion, but we're only saying 22% of the houses have that. What that means is those high balance people that have 50,000 plus in their student loans, they make up 60% of that 1.3 trillion. So you actually have a small-ish amount of people that have loans, but huge kind of density. You have people that have high balances. So it's a really interesting phenomenon because when I speak with the mortgage brokers and I say, hey, are you seeing that student loan debt is stopping people from purchasing homes? Every single broker, and I'm not exaggerating, says, no, when people have student loan debt, they're able to make it work. But what I've realized, because those are people that are actually talking to someone with that, going to buy a home. That doesn't include people that are saying, I know that I have $50,000 in student loan debt and I know I can't purchase a home. So I think their data is a little bit skewed because it probably is impacting the housing market more than the brokers would like to tell you. But it's in a lot of ways, when there's a will, there's a way. I know someone that has $200,000 in student loan debt and still owns a home. Obviously, they're making fairly good money to be able to do that. But you also have a large percent of these young people that are just priced out right now because they have too much in debt.
Yeah, certainly. Let's talk about a metric that you frequently cite, and there's a lot of people out there that focus on this as the number one predictor of a recession, which is the spread between the 10-year and the 3-month. Can you talk briefly about why this is an important metric and a little bit your thoughts on this topic as a whole?
this topic has become so fun over the past few months. So this is I completely agree. I know that I cite it. I know other people you speak with cite it. You want to watch where bond investors are putting their money. Are they doing it in short-term bonds or are they doing it in long-term bonds? And by looking at where they're investing their money, you kind of have a gauge of their perception of a recession. Again, you're assuming that the bond market knows more than we do, but you can say, okay, they're investing more in long-term bonds because they think maybe a recession's right around the corner. The issue right now is that's not what we're talking about. Right now, we're talking about first Friday of every month. We talked about the jobs report, came out 2.9% year-over-year wage growth. Just yesterday, personal consumption expenditure index, which is a measure of inflation, the Fed's preferred measure, showed 1.9%. There's now this fear that the Phillips curve is coming to life. So the relationship between unemployment rate and inflation. With all of that, the bond market says, I need some kind of way to control my risk. So they require a term premium, pushing up the treasury yields. So when you look at the 10-year, if you look at the chart just over the past month, the 10-year treasury yield is just like a hockey stick. And that goes back to mortgage rates because there's a direct relationship between the bond yield and mortgage rates. Mm-hmm. So it's a really interesting dynamic right now. And I'm not necessarily concerned about it becoming inverted right now. We're actually seeing it go the other direction.
Okay. But would you say then that this is, frequently this is something that people should keep an eye on, generally speaking, or is this, out of the window this time because of this kind of phenomenon that you're talking about?
No, definitely keep it. Definitely watch it. I think it's critical to watch. It's critical to see what's going on with the bond market because if you remember with the Clinton era, the bond vigilantes, they can come and they can overrule any kind of policy that you put in place because the bond market really can control a lot of things more than you would think. So really important to watch bond market and an inverted yield curve.
Cool. And I appreciate the analysis and the summary there. With that in mind, where do you anticipate seeing interest rates, going over the next 2 to 5 years?
Again, if I could do this, oh my gosh, I wouldn't be driving the car I'm driving.
I guess it's the analysis more than the actual call, right? We're not going to hold you to it.
So what I will say is if you look at, now let's take a step back from the bond market right now and let's talk about the Fed. Let's talk about how the Fed has raised rates. I think it's 5 times so far, and they're anticipating 3 more times this year. That is impacting the short-term rates. And so that is the, I'm blanking on the name, but the federal funds rate. There we go. So you're looking at the federal funds rate. You're looking at the spread between mortgage rates and federal funds rate. And historically, that's 3%. So if you assume that same kind of spread, that alone is calling for mortgage rates to be between 4 and 6% by the end of this year. Now, the 6% I think is more of a CYA than reality. I'm not entirely sure that we will see mortgage rates at 6% at the end of this year. But the Fed can only do so much. Again, going back to the bond market, it really depends on, does inflation continue to tick up? Does the bond market or the bond vigilantes, do they start to play into this? I wouldn't be surprised to see 6% over the next few years. I wouldn't call that by the end of this year. I think consensus is about 5% end of this year.
Out of curiosity then, going back to the affordability question, what do you anticipate that doing to affordability if they do hit those numbers that you're kind of discussing right there?
Oh, that makes me nervous. That's been kind of my biggest concern for a few different reasons. So I already told you about how much just 50 basis points changes the monthly payment. Let's now add in, and again, I don't have this exact stat right now, but it's something like 50% of all the mortgages out there have an average interest rate of 3.7%. And I talked about earlier about game theory and people not seeing other homes on the market. If you have a home right now at a 3.7% mortgage rate and rates go up to 6%, what's going to be your incentive to sell that home? Okay, so maybe you have kids, so you need a bigger house. Maybe you switch jobs, so you have to move cities. But there are going to be a lot of people that say, I locked in this really low interest rate, and you know what? I don't love it, but I can remodel it. And we've seen the remodeling index, and we've seen Home Depot, we've seen their stocks have just completely taken off because there are some people that are choosing to stay put, which of course, lack of supply, driving prices even higher.
Man, that's fascinating. We could have an entire conversation on that entire the affordability interest rate entire thing. Are there any other early warning signs that you kind of keep an eye on, but besides the affordability and interest rates and maybe the spread between the 10-year and the 3-month?
So right now, my big focus is on debt. And you talked a bit about the student loan debt, and then we look at the credit card debt, and we look at auto loan debt. And it makes me a little bit nervous to see how high the levels are getting. Right now, the breakout is about 40% student loan debt, 40% auto debt, 20% credit card debt. But debt in and of itself, as long as you have a job and as long as you have a steady income, isn't really a problem until you start defaulting. So we think defaults, not on mortgages, because if you just think as a consumer, you have your credit card debt, you have your mortgage, you're probably not going to default on your mortgage first. You're going to default on your credit card first. So I think just starting to see if people are starting to over leverage themselves and not able to pay off their basic expenses, I really like to look at that as well.
Okay, awesome. Well, Ali, that really covers, I mean, we went through so much ground. I know that you mentioned several times, so I don't have the statistics in front of me. Well, you managed to handle a lot of these really detail-oriented questions, so I really, really appreciate you taking the time. If you wouldn't mind, let the listeners know how they can find more about your work and get in contact with Meyers Research as a whole.
Sure. So for one, I'm also on a different podcast. It's a millennial-based podcast that talks about every different aspect of real estate, whether it's hospitals, whether it's for sale housing, rental housing, coffee shops, whatever it is. And that's called Spaces Podcast. So we're at spacespodcast.com. My email, and some of you may disagree with some of my analysis, and I'd love to hear it because I think we all get smarter by hearing different sides of the story. So please feel free to send me an email, awolf, like the animal, at meyersllc.com. And then my company's website is Meyers Research. LLC.
Okay, perfect.
Yeah.
I will make sure to link to those in the show notes page so people have easy access to it. So again, Ali, I can't thank you enough. I really appreciate it. Thanks again.
No, of course. Thank you.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.